Usually when we talk about a medical diagnosis, there's this expectation of like absolute precision. It feels almost like engineering.
Yeah, you expect it to be clear-cut.
Right. You break your arm, the x-ray shows that jagged white line on the radius bone, and the doctor just points at it and says, there it is. That is the problem.
It's binary. It's either broken or not broken.
Exactly. It's clean, it's undeniable. But then you try to look for the perfect business to invest in, and suddenly it feels like that x-ray machine is completely malfunctioning.
Oh, for sure. The corporate landscape is just incredibly murky.
It really is. It's filled with noise, accounting tricks, and these fleeting trends. But today, you and I are on a very specific mission. We're assuming you, the listener, are a public market investor.
And you are searching for the absolute rarest of assets in the financial universe.
Right. We are talking about finding a high-quality business that's worthy of perpetual ownership.
Right.
We aren't looking for, like, a 6-month trade here.
No, definitely not.
And we aren't looking for a multi-year cyclical hold either. We are looking for perpetual. A business you can buy, put in a drawer, and literally just let calmness for decades.
And today, the company we are putting under that fundamental microscope is Sartorius.
Yes, Sartorius.
But if we're genuinely looking for a perpetual asset, we have to establish some unbreakable ground rules right out of the gate.
Okay, lay them out.
Today, we are throwing valuation completely out the window.
Love it.
We are not going to talk about price-to-earnings ratios. We are not going to debate the nuances of discounted cash flow models. And we are certainly not, speculating on multiple expansion.
Right. Our sole unwavering focus today is fundamental business quality.
Exactly. We're going to dissect the brutal mechanics of their unit economics.
Right.
We'll stress test the durability of their competitive moat.
We also need to scrutinize the management team's track record of capital allocation, right? Specifically where they've succeeded and, well, where they've stumbled.
Absolutely. And finally, we'll evaluate the real staying power of the industry's secular tailwinds.
And, the reason we picked Sartorius for this deep dive is because the evolution of this company is just fascinating.
It really is quite a story.
If you just hear the name Sartorius, it sounds like some boring legacy industrial conglomerate. And to be fair, they actually started out over a century ago as a mechanical workshop making precision scales.
Right, a very traditional manufacturing background.
Yeah, but over the decades, they have morphed into this absolute biomanufacturing juggernaut. If there's a gold rush happening in the biopharma world right now.
Which there absolutely is, with gene therapies, monoclonal antibodies, next-gen vaccines.
Exactly. Sartorius is the one selling the most sophisticated picks and shovels ever designed for that gold rush. But they also just survived one of the most volatile boom and bust cycles in modern economic history.
Yeah, driven entirely by the COVID-19 pandemic.
Right.
And if we connect this to the bigger picture, the challenge for any investor looking at Sartorius today is stripping away that pandemic noise.
Because it's deafening.
It is. The data from the last few years is blindingly loud in their financial statements. We have to figure out if their fundamental engine can sustainably generate returns above their cost of capital for the next decade and beyond.
And by engine, you mean essentially selling sterile, single-use plastics and highly specialized bioprocessing equipment.
Exactly. We have to separate what is a structural, permanent reality of this business from what was simply, a pandemic-induced hallucination.
Wait, let me stop you right there. Before we even get into the pandemic numbers, I need to understand this fundamental engine. You just said their engine is selling sterile, single-use plastics.
Yes.
If I'm an investor looking for an impenetrable fortress of a business, selling plastic bags doesn't immediately scream impenetrable moat. It sounds like a commodity.
I get why you'd think that.
Why are we talking about them as a perpetual asset? So let's unpack the Sartorius Bioprocess Solutions Division, or BPS, because this is the star of the show.
It absolutely is the core driver.
The notes say they provide complete process solutions for manufacturing biologics. Can you actually break down what that means? Because I suspect a biologic drug is fundamentally different from, the aspirin in my medicine cabinet.
Oh, that distinction is the entire foundation of the Sartorius thesis. It's exactly why these aren't just commodity plastic bags.
Okay, lay it out for me.
When you take an aspirin, or any standard chemical pill, you're taking a drug that was synthesized through a totally predictable chemical reaction.
It's just a recipe, basically.
Exactly, it's a recipe. You mix chemical A with chemical B in a giant steel vat. You get exactly the same aspirin every single time. It's highly predictable and relatively easy to scale.
But biologics aren't like that.
Not at all. Biologics are an entirely different universe. These are drugs like monoclonal antibodies used to treat cancer, or mRNA vaccines, or those advanced cell and gene therapies that are manufactured using living organisms.
Wait, living organisms like bacteria or mammalian cells?
Exactly. You are literally genetically engineering living cells. Often, Chinese hamster ovary cells are, a popular workhorse in this industry.
Chinese hamster ovary cells, that's wild.
It is, and you are programming those living cells to secrete the specific therapeutic protein you want to harvest. You aren't mixing chemicals, you are farming microscopic livestock.
Oh, wow. Farming microscopic livestock. That paints a picture.
Right. And because you're dealing with living, breathing biological systems, the process is incredibly sensitive. The temperature, the pH level, the dissolved oxygen, the specific nutrients you feed them.
I imagine there's zero margin for error.
Basically zero. If any of those variables shift even slightly, the cells might die, or worse, they might mutate and produce a dangerous variant of the drug.
Okay, so the manufacturing process isn't just a way to make the drug. In biologics, the process literally is the product.
Precisely. The phrase, "the process is the product," is basically the mantra of the biopharma industry. And this brings us directly to the regulatory moat. This is what elevates Sartorius from a plastics manufacturer to a near monopoly in certain niches.
Okay, I'm listening.
What's fascinating here is the concept of the validated process. When a pharmaceutical company develops a new biologic drug, they have to run massive, insanely expensive clinical trials to prove it's safe and effective.
Right, standard FDA stuff.
Yes, but when they finally take that data to a health authority like the FDA in the US or the EMA in Europe, they don't just ask them to approve the final drug.
They don't.
No, they must ask the FDA to approve the exact step-by-step manufacturing process used to make the drug during those successful clinical trials.
Ah, and this is where Sartorius gets written into the DNA of the drug's approval.
Exactly. The FDA scrutinizes every single component that touches that living cell culture. The specific, sterile, single-use bioreactor bag they are grown in.
The tubing, too.
Yes, the specific proprietary tubing the liquid flows through. The specific microscopic filters used to purify the final protein. All of these components, down to the exact Sartorius model and serial numbers, are written into the regulatory filing.
Wow.
Once the FDA stamps approved on that drug, that specific combination of Sartorius equipment is legally validated as the only acceptable way to manufacture that drug.
Let me try an analogy here to make sure I grasp the gravity of this switching cost.
Go for it.
Let's say I'm building a massive 100-story skyscraper, and the city council passes a law saying that I am only allowed to use a very specific brand of titanium screws to hold up the drywall.
Okay, I like where this is going.
If, like, 5 years later, a salesman comes to me and says, hey, I have these generic screws that are 20% cheaper, I can't just swap them out, right?
You absolutely cannot.
To use the new screws, the city council mandates that I have to completely evacuate the building, tear down all the drywall, retest the structural integrity of the entire skyscraper with the new screws, and then reapply for my building permit from scratch. Is that what we are talking about here?
That is a phenomenal analogy. It perfectly captures the financial and operational reality of the plant manager. Scrapping a core component post-approval means you have to go back to the regulatory authorities.
You have to ask for permission all over again.
Yes, you have to undergo what is called revalidation.
Yeah.
You have to manufacture multiple test batches of the drug using the new, cheaper filter.
Which takes time.
Lots of time. And then you have to run exhaustive analytical testing and sometimes even new mini-clinical trials to absolutely prove to the FDA that this cheaper filter hasn't altered the drug's efficacy, its safety profile, or introduced any new microscopic impurities.
Which would cost, what, millions of dollars?
Millions of dollars in direct testing costs, yeah. But the real cost is time and risk. You can take months or over a year to complete revalidation.
A year.
Easily. And during that time, the manufacturing line might be completely shut down. If this is the blockbuster cancer drug, that manufacturing line is generating millions of dollars of revenue every single day.
So the opportunity cost is astronomical.
Exactly. Furthermore, what if the FDA looks at the new data and says, we see a 1% variation in the protein folding? Revalidation denied. You just risked the golden goose.
So if I'm a plant manager, my primary incentive isn't to save a few $1,000s on filters. My primary overriding incentive is zero downtime and zero regulatory risk.
Spot on.
No plant manager is going to risk their career and the production of a billion-dollar drug to save pennies on a generic piece of plastic It's the ultimate captive audience.
The financial manifestation of this captive audience is just staggering. Roughly 75% of the Bioprocess Solutions division's sales revenue is recurring.
Let's do 5%.
Yeah, it is almost entirely these sterile single-use products. Decades ago, biopharma used giant stainless steel vats that had to be rigorously cleaned and sterilized with steam between every single batch.
Sounds incredibly inefficient.
It was. Now, the industry has shifted to Sartorius's single-use model. You use the giant plastic bioreactor bag once, you throw it away, and you buy another one. You use the purification filter once, you throw it away, and you buy another one.
I was actually looking at the notes from some expert calls we have, specifically an interview with a former Sartorius employee conducted in 2026.
Okay, what did they say?
Well, this employee confirmed that this lock-in creates genuine, durable pricing power. They noted that Sartorius consistently pushes through 3% to 7% annual price increases on these consumable products.
And the customers just pay it.
Exactly. The drug manufacturers basically just have to accept it. They might grumble about it, but the regulatory lock-in is so strong that they just pay the invoice.
They don't really have a choice.
And the notes also highlight that Sartorius isn't just a broad player. They aggressively dominate very specific critical niches to ensure this lock-in happens as early as possible.
Okay.
They specifically highlighted something called the Ambrid bioreactor system. Can you explain what that is and how it functions as a trap?
Oh, the Ambry system is a masterclass in building a moat at the very beginning of the customer journey. Ambry stands for Advanced Microbioreactor.
Microbioreactor.
Right. When scientists are in the very early R&D phases of trying to invent a new biologic drug, they don't use 2,000-liter production vats. They need to run thousands of tiny parallel experiments.
To find the right formula.
Exactly, to figure out the exact perfect temperature, the perfect pH, and the perfect nutrient mix to make these cells thrive.
Right, it's trial and error on a microscopic scale.
Exactly. So the Ambry system is essentially a highly automated robotic workstation that runs dozens of miniature, perfectly controlled bioreactors simultaneously. It is widely considered the absolute gold standard in the industry for process development.
Because everyone uses it.
Most of the top players do.
Right.
Now, here is where the lock-in happens. When a scientist discovers the perfect recipe for growing their new drug using the Sartorius Ambry system, the software and the scaling mechanics are specifically designed to translate seamlessly to Sartorius's larger commercial-scale bioreactors.
Ah, I see. So by getting their equipment onto the lab bench when the scientists are just playing around with early molecules, Sartorius ensures that when that drug eventually advances to clinical trials,
Which takes years.
right, and then to commercial mass production, the entire manufacturing process is already inherently designed around Sartorius equipment and Sartorius single-use consumables. They literally lock you in at step 1 years before the drug is even approved.
Precisely. Once that drug is approved, the lifetime value of that customer is practically guaranteed for the life of the drug's patent, and often well beyond it into the biosimilar phase.
So we have a nearly impenetrable regulatory moat, a massive 75% recurring revenue base, and the ability to raise prices 3% to 7% every year without losing customers. This sounds like absolute financial nirvana.
It's an incredible setup.
But I'm looking at their actual revenue numbers. Specifically in 2023, the floor completely fell out.
Yeah, that was a tough year.
So we have to transition to the macro environment here. Let's talk about the secular tailwinds versus the COVID-19 distortion, because the environment Sartorius operates in is clearly not static.
Right. To accurately assess the risk here, we first had to establish what the normal baseline looks like without a global pandemic.
Sure.
The biopharma industry is fundamentally sound, and it is being propelled by massive, unstoppable secular trends. We're looking at a rapidly aging world population, which is projected to hit roughly 9 billion by 2050.
And older populations need more medicine.
Exactly. As populations age, the incidence of chronic diseases and cancers, which are the primary targets for biologic drugs, increases exponentially.
And we are also seeing a rising middle class in emerging markets, correct? Places where access to complex healthcare was previously limited, but incomes are rising to a point where these advanced therapies are becoming accessible.
Absolutely. And if you look at the research and development pipelines of the major pharmaceutical companies, it heavily reflects this shift. Over 40% of all new drug candidates currently in development are biologics.
Wow, 40%.
Yeah, the era of traditional chemical pills dominating the pipeline is over. We are moving toward incredibly complex, biologically derived medicines. And a massive specific growth driver within that is the booming biosimilars market.
Okay, I need you to explain biosimilars because the notes mention this is a huge tailwind, particularly in Asia. Are biosimilars just generic drugs?
Conceptually, yes, they are the equivalent of generic drugs, but the science and manufacturing are vastly more complex. When a chemical drug like aspirin loses its patent, another company can just copy the chemical recipe and make a perfect generic copy.
Because it's just chemicals.
Right. But remember, with biologics, you are dealing with living cells. You cannot make an identical copy of a living organism's output. You can only make a product that is highly similar in its clinical effect, hence biosimilar.
Okay, so when the patent expires on a massive blockbuster biologic drug, let's say a major arthritis medication, other companies can swoop in and try to manufacture a biosimilar to compete on price.
Exactly. And to compete on price, these biosimilar manufacturers, many of which are scaling up massively in Asia, need to produce enormous volumes of the drug.
Which means they need equipment.
A ton of it.
Yeah.
This requires a staggering build-out of new physical manufacturing capacity. They need thousands of new bioreactors, millions of new filters, and endless miles of single-use tubing. This is a massive structural tailwind for Sartorius.
I bet.
Industry experts, including former executives we sourced, confirm that this baseline core market for bioprocessing equipment and consumables grows structurally at roughly 10% annually.
A 10% structural annual growth rate in your underlying market is phenomenal, but we have to talk about the massive distortions sitting in the middle of their historical financials.
The elephant in the room.
The period from 2019 to 2023. During the COVID-19 pandemic, Sartorius basically became the critical supply chain backbone for the global vaccine rollout.
They were essential.
They provided the bioreactors and the sterile bags to scale up production basically overnight. And the numbers reflect a parabolic boom. From 2019 to 2022, they saw 87% sales growth and 94% EBITDA growth. It was an absolute frenzy.
It was unprecedented.
But then the hangover hit. In 2023, the Bioprocess Solutions division saw its sales absolutely tank by 16.6%.
Yes, the 2023 cratering.
Now, I'm a public market investor looking for a perpetual hold, and when I see a company with a supposedly impenetrable moat lose 16.6% of its revenue in a single year, all my alarm bells go off.
As they should.
Management blamed this purely on a post-COVID destocking phenomenon, but I have to ask, is that the actual truth? Or did Sartorius actually lose market share during the chaos of the pandemic? Did competitors sneak in while everyone was distracted?
This raises a vital question about intellectual honesty when evaluating management commentary. Management teams are heavily incentivized to spin a terrible quarter as an external, uncontrollable macroeconomic event, right?
Oh, absolutely. It's the economy. It's not us.
Exactly. But if we rigorously examine the data, the biopharmaceutical end market is largely independent of traditional macroeconomic business cycles. If there is a recession, people still get cancer. People still need their autoimmune medication.
The demand for the actual drugs doesn't change?
Right. The actual volume of drugs being consumed by patients didn't drop by 16.6%.
So what actually happened? If patients were still taking the drugs, why did Sartorius stop selling the manufacturing equipment?
It was entirely driven by an unprecedented inventory cycle, the classic bullwhip effect. During the peak of the pandemic in 2021 and 2022, global supply chains were completely breaking down. Drug manufacturers were terrified.
Naturally.
If you're manufacturing a life-saving drug and you hear that container ships are backed up for months, you panic. You cannot risk your production line shutting down just because you ran out of a specific Sartorius filter.
So they hoarded. They just bought everything they could get their hands on, regardless of their immediate needs.
Precisely. They double, triple, and quadruple ordered bags, filters, and cell culture media, literally stuffing their warehouses to the ceiling.
Just to be safe.
Yep. This created a massive artificial pull forward of demand that massively inflated Sartorius's 2021 and 2022 revenue. But by 2023, the supply chains finally normalized.
And the music stopped.
The drug companies looked at their warehouses, realized they had 2 years' worth of Sartorius filters just sitting on the shelves, and simply stopped ordering.
So it truly was an inventory digestion issue, not a fundamental loss of competitiveness or a crack in the regulatory moat.
The evidence strongly points to it being purely an inventory digestion issue. By the time we analyze the 2025 financial data, we see the normalization taking hold.
What do the 2025 numbers look like?
Group sales growth returned to a healthy 7.6%, and the BPS division specifically bounced back up 9.5%. The secular tailwinds, the aging population, the shift to biologics, the biosimilar boom, they all held up perfectly fine. The pandemic simply created a massive distortion in the timing of the orders, confusing the entire supply chain.
Okay, so the secular growth story is intact, and the recurring revenue moat is intact. But here's the problem. Revenue growth and competitive moats do not automatically equal cash in the bank for shareholders.
No, they certainly do not.
You can have a monopoly, but if you run the business poorly, you destroy shareholder value. So if we are evaluating this for perpetual ownership, we have to look at how effectively this business converts that sticky revenue into actual cash. Let's dive into the unit economics and the absolute roller coaster of their profit margins.
This is where the narrative gets significantly more complicated and where a long-term investor must exercise extreme caution.
All right, lay out the margins.
If we trace Sartorius's underlying EBITDA margins, earnings before interest, taxes, depreciation, and amortization, they have fluctuated violently. Back in 2016, they were operating around a 25% margin.
Which is pretty solid.
It's very healthy, but it's relatively standard for a high-quality industrial manufacturer. Then, during that peak pandemic hoarding frenzy of 2022, margins exploded to a massive 36.2%.
Wow. And then crashed all the way back down to 28.3% in 2023 when the destocking hit, before stabilizing around 29.7% in 2025.
Exactly.
I have to push back here. We just established that 75% of their revenue is recurring, locked-in, consumable sales where they raise prices every year. How can a business with that much inherent stability experience such extreme margin volatility? It just doesn't make sense to me. Where is the friction?
The friction lies in the brutal physics of their manufacturing process and the mathematics of operating leverage. You have to remember what they're actually building. Manufacturing single-use plastics for the biopharma industry is not like stamping out plastic forks.
Right.
These consumables must be manufactured in massive, state-of-the-art sterile clean rooms.
Because if a single dust mite or bacterial spore gets inside a bioreactor bag during manufacturing, it ruins the final drug.
Exactly. It's a disaster. So Sartorius has to build these massive facilities, going to have to validate the clean rooms. They have to run incredibly power-intensive HVAC systems 24/7 to maintain the air pressure, the temperature, and the absolute sterility of the environment.
That sounds incredibly expensive.
The fixed costs required just to turn the lights on are astronomical.
So the very first plastic bag that comes off a new assembly line essentially costs tens of millions of dollars to make. But the 10,000th bag costs pennies.
That is the essence of operating leverage. On the way up from 2020 to 2022, when customer order volumes were surging to unnatural highs and pushing through their existing facilities, the incremental margins were phenomenal.
Because the fixed costs were already paid for.
Right. Almost every single extra euro of revenue they generated dropped straight to the bottom line because all of those massive fixed facility costs were already covered by the baseline volume. Operating leverage makes you look like an absolute genius in a boom. But it is a violent double-edged sword. When order volume craters by 15.6%, as it did in 2023, those fixed costs do not disappear. You still have to pay to heat, cool, and rigorously sterilize half-empty clean rooms. The leverage violently crushes your margins on the way down.
I was digging through the transcripts from their past earnings calls, trying to understand just how bloated this cost structure got. And I found a statistic from the 2021 earnings call that genuinely shocked me.
Oh, the hiring number.
Yes. Management proudly announced that Sartorius hired 2,100 people in just the first 9 months of 2021. And then the CFO openly admitted on the call that 60% of these new hires were functional expenses.
Meaning management, HR, administrative staff, marketing.
Right. Not direct laborers actually manufacturing products on the factory floor. They vastly, almost recklessly, expanded their fixed organizational overhead right before demand plummeted. Why would they do that?
It's a classic corporate misjudgment. They looked at the pandemic-fueled artificial surge in revenue and mistakenly believed it was the new permanent baseline.
They bought their own hype.
Completely. They built an organizational structure designed to support a level of perpetual hypergrowth that simply wasn't real. And that severe misallocation of capital bled straight into their working capital efficiency, basically destroying their cash conversion.
How bad did the working capital get?
Well, during that same peak period in 2021, their balance sheet absolutely ballooned. It expanded by roughly €1 billion, and nearly half of that bloat was tied up entirely in inventory and receivables.
€1 billion.
Yeah. They were manufacturing furiously, stockpiling raw materials, storing finished goods in warehouses, and waiting extended periods to get paid by customers who were also, frankly, overwhelmed.
So they were burning cash to build inventory for demand that was about to vanish. And the hangover from that structural bloat lasted for years.
It takes a long time to unwind that.
Even looking at the recent 2025 data, their operating cash flow dropped to 511 million euros, which was actually down 16% from the prior year. And free cash flow, the actual cash left over for shareholders, dropped to a meager 200 million euros.
The stark drop.
It sounds to me like they built a massive, state-of-the-art 12-lane highway, assuming there would be rush hour traffic 24 hours a day. But now it's midday, the traffic is gone, and they still have to pay the immense maintenance costs for all 12 lanes. Can they ever actually grow back into that peak 36% margin profile, or is that permanently gone?
If we are being rigorously intellectually honest, as any perpetual owner must be, we have to assume the 36% margin was a complete anomaly, a pandemic hallucination.
Not a structural reality.
Exactly. It is not their structural reality. Yes, they did manage to drive 2025 margins up by about 200 basis points to 29.7%, largely through finally achieving some economies of scale again and a more favorable mix of high-margin products.
But they're still way off from 36%.
They are structurally far below that peak. And importantly, we cannot ignore their capital intensity. Their capital expenditure ratio, or CapEx, remains heavy at roughly 12.5% of total sales.
And where is all that CapEx going if they already overbuilt?
They're actively building out massive new manufacturing and R&D facilities globally to get closer to their end markets and build redundancy. They are heavily investing in major sites in Songdo, South Korea, Aubagne, France, and Freiburg, Germany.
So the capital intensity is a permanent feature of the business, not a bug.
Correct.
The unit economics are objectively strong. I mean, a 30% structural EBITDA margin is nothing to sneeze at. Most companies would kill for that. But we must accept that they have structurally reset lower than management's peak optimism.
That's the reality.
And this massive misjudgment of capacity, this reckless hiring spree of functional managers, and the subsequent margin collapse leads us directly to the next crucial pillar of our thesis. Who exactly is making these capital allocation decisions? If we are buying this forever, we need to trust the people steering the ship.
Evaluating management quality and their capital allocation track record is where we have to look past the marketing gloss and be highly critical.
Okay, let's look at leadership.
For 25 years, Sartorius was led by a CEO named Joachim Kreuzberg. His tenure is an undeniable legacy of value creation. He literally took them from being a specialized mechanical workshop and architected their pivot into a global life sciences powerhouse.
A truly impressive run.
However, he recently retired, handing the reins to a new executive team during a period of extreme structural transition and market volatility.
I was looking at how this new executive team is incentivized because you always want to know what drives management behavior. Their compensation is tied to a mix of short-term targets, things like sales volume, EBITDA margins, and their net debt ratio.
Which all makes sense.
That all makes sense. But surprisingly, a portion of their compensation is also tied to the Employee Net Promoter Score, or ENPS.
Tying executive compensation to employee satisfaction is an interesting, somewhat modern choice. Theoretically, it promotes a healthy corporate culture and retention of top talent. But if we want to truly understand management's mindset, we shouldn't look at their HR metrics. We should look at their capital allocation track record, specifically their M&A playbook, because a very distinct, aggressive pattern emerges there. They are prolific acquirers.
Extremely aggressive. Looking at the notes, over the last few years, they bought a company called Cellgenics. They bought Zell, which specializes in viral vector media. They bought Novocep's chromatography division. They acquired ALS for automated lab solutions. And they made a massive purchase of a company called BIA Separations. Can you explain the strategy here? What are they actually buying?
Strategically, the M&A playbook is arguably brilliant. They are explicitly using the cash flow generated from their legacy traditional bioprocessing business to buy their way into the highest growth, most scientifically complex niches of the future.
The advanced therapies.
Specifically, they are aggressively targeting the supply chain for advanced cell and gene therapies.
Okay, let's break that down a bit. Why did they buy Zell for viral vector media? What is a viral vector and why is it important?
In gene therapy, you are often trying to deliver a corrected gene into a patient's cells to cure a genetic disease. But you can't just inject raw DNA into a person's bloodstream. It won't get inside the cells. You need a delivery vehicle.
Like a microscopic Trojan horse.
Exactly like that. Scientists often use modified viruses that have been gutted of their disease-causing elements to carry the healthy gene into the patient's cells. That delivery vehicle is the viral vector.
Got it.
And Cell specializes in the highly complex nutrient media required to grow those specific viral vectors at a commercial scale.
I see. And what about Novocep's chromatography division?
Well, once you grow a complex biologic in a bioreactor, you end up with a massive soup of living cells, dead cells, waste products, and the specific therapeutic protein you actually want.
A messy soup.
Very messy. Chromatography is the highly sophisticated, incredibly expensive process of filtering and purifying that soup to extract only the pure therapeutic protein. By acquiring Novacep, Sartorius bolstered their dominance in the downstream purification process, which is often the most complex and tightly regulated step of manufacturing.
So they're securing the bottlenecks.
They are acquiring these specialized, future-facing technologies and immediately plugging them into that dominant global direct sales force we discussed earlier.
I understand the strategic brilliance. Buying the bottlenecks of the future is smart. But strategically brilliant doesn't always translate to financially disciplined.
That is very true.
There is immense financial volatility attached to this aggressive string of acquisitions. For example, the notes highlight that just the earnout liabilities for the BIA separations acquisition alone caused a €55 million negative swing in Sartorius's financial results in 2021.
An earnout is a structure where you agree to pay the sellers additional money in the future if the acquired company hits certain aggressive financial targets.
Right, so it shows they are paying absolute top dollar for these assets, and they are structuring deals with massive contingent payouts that add a significant layer of unpredictability to their future cash flows.
It definitely adds risk.
And frankly, this unpredictability is compounded by some very concerning signals we see from the ground level. You mentioned their compensation is tied to employee satisfaction via the ENPS score, yet the insights we have from former employees speaking in 2026 paint a very dark, contradictory picture of the culture during that boom and bust period.
Yes, this is the skeptic's view, and it is vital for a public market investor to weigh this heavily.
What did the employees say?
One former employee expert explicitly called out a deeply negative culture within the commercial organization during the pandemic peak and the subsequent painful decline. They described a high-stress environment characterized by rapid turnover, constant chaotic restructuring, and a leadership team that was described as deeply insular.
Insular. That's a dangerous word for a management team.
Very dangerous.
The expert noted that the people running the commercial side had almost entirely risen through the ranks internally at Sartorius. They had spent their entire careers there and lacked broad outside market exposure.
An insular culture, during a period of massive, unprecedented hypergrowth, is a highly combustible combination. It perfectly explains how a management team could authorize the hiring of 2,100 people in 9 months, heavily skewed toward middle management, without anyone standing up and recognizing that the underlying demand was an artificial pandemic-induced bubble about to burst.
Groupthink.
Exactly. It leads to severe groupthink. Everyone in the room agrees with each other, and no one challenges the incredibly optimistic assumptions. And that groupthink resulted in what is arguably the biggest, most glaring red flag for this new management team: the spectacularly broken promise of their 2025 financial guidance.
We absolutely have to talk about the 2025 guidance. In 2022, right at the absolute peak of the pandemic euphoria, when margins were at 36%, management held an investor day.
I remember it well.
And they boldly told Wall Street that they are formally guiding for €5 billion in group revenue and a 34% EBITDA margin by the year 2025.
And let's remind the listener of the reality. What were the actual finalized 2025 results?
Roughly €3.4 billion in revenue and a 29.7% margin. They missed their own revenue projection by a staggering €1.5 billion.
It's a colossal miss.
They missed their margin target by over 400 basis points. That is not a slight miscalculation. That is an astonishing forecasting failure. It shows a complete misunderstanding of their own market dynamics.
And the damage wasn't just reputational. That forecasting failure was accompanied by a dangerous stretching of their balance sheet. Because management genuinely believed that €5 billion revenue number was a certainty, they spent heavily on M&A and initiated massive CapEx projects, assuming those future cash flows would easily cover the costs.
They spent money they didn't have yet.
When the revenue evaporated, their net debt to underlying EBITDA ratio violently spiked to a precarious 5.0x in 2023.
5.0x leverage for an industrial manufacturer is incredibly risky. To be fair to them, the recent data shows they have actively deleveraged since that peak, bringing the ratio back down to a more manageable 3.55x in 2025.
Which is an improvement, yes.
But it reveals how incredibly quickly their capital allocation framework can get stretched to the breaking point when the macroeconomic tide goes out.
Exactly.
So, as an investor, I have to synthesize this. What does this all mean? We have a management team whose compensation is theoretically tied to employee satisfaction, yet insiders report high turnover and an insular negative culture.
A huge disconnect there.
They missed their midterm revenue guidance by a mile, leveraging up the balance sheet dangerously in the process because they bought into their own pandemic hype. Are we essentially looking at a phenomenal, structurally advantaged business that is currently being operated by a disrupted, perhaps slightly arrogant and unproven new management team?
If we practice strict intellectual honesty, which is our mandate today, the conclusion regarding management is heavily mixed.
Okay, give me the nuanced view.
The capital allocation directed toward critical M&A in the cell and gene therapy space has been, objectively, largely accretive to the structural long-term moat. They bought the right technological assets to secure their future.
The strategy was right.
But operationally, management got caught swimming completely naked when the pandemic inventory tide went out. The lack of communication candor regarding those overly ambitious 2025 targets, clinging to them publicly long after it was obvious to everyone in the industry that the market had fundamentally turned, is a permanent ding on their credibility.
It's hard to forget that.
For a perpetual owner, you must mathematically factor in a management discount. You simply cannot take their forward-looking financial guidance at face value ever again.
Okay, I think that's a fair and appropriately skeptical assessment. So with the legendary old CEO gone, the new team in place, the massive pandemic inventory digestion mostly finished, and a realistic new financial baseline established at roughly 3.4 billion euros. Where is this reinvestment engine pointing today? What is the future runway for growth?
The current growth initiatives and the accompanying capital expenditures are heavily focused on expanding their capabilities in cell culture components, those viral vectors we discussed, and increasing their geographic footprint to physically be closer to emerging customer bases, hence the major ongoing CapEx projects in South Korea and Germany.
The structural shift towards cell and gene therapies provides a truly massive, decades-long reinvestment runway. Because if we think about the complexity we're talking about, taking a patient's own immune cells out of their body, engineering them in a lab using viral vectors to hunt cancer, and putting them back into the patient, the regulatory barriers and the switching costs for that manufacturing process will be exponentially higher than they are for traditional monoclonal antibodies.
Exactly.
The moat actually deepens as the science gets more complex.
That is the absolute core of the bull case for reinvesting cash into this business for the next decade. The science is moving in a direction that inherently favors Sartorius's expertise in highly complex, tightly regulated, sterile environments.
But there are threats, right?
However, we cannot ignore the emerging threats to their legacy business. A very recent expert call from 2026 explicitly noted a changing dynamic. Asian competitors are beginning to aggressively compete on price for high-volume, lower-complexity products. We are talking about things like basic chemical buffers and standard cell culture media.
Right. If the product is essentially just mixing highly purified salt water and basic nutrients in a plastic bag, the technological moat is shallow. It's much easier for a new competitor to replicate that than to replicate a sophisticated chromatography system.
Exactly. The risk here is margin dilution. Sartorius must maintain its absolute technological edge in the highly complex, critical downstream applications, like that sophisticated Novacep chromatography and their ultrafine filtration systems to protect its overall unit economics.
They have to stay at the high end.
If they get dragged into a brutal commoditized price war on basic volume consumables in Asia, their blended corporate margins will structurally suffer, dragging down returns on invested capital.
Okay, let's bring it all together for you, the listener, our public market investor, looking for that elusive perpetual hold. Let's summarize the rigorous analysis we've done today. Let's define exactly where the bull case fails and where it ultimately wins.
Let's do it.
The bull case for Sartorius fails if you are a naive investor who believes management can seamlessly return the business to those peak 36% margins of 2022. It fails if you blindly trust their forward guidance without a massive grain of salt.
Absolutely.
It fails if you believe they won't face intense margin-compressing pricing pressure on their lower-tier consumable products from aggressive new entrants in emerging markets. And frankly, it fails if you simply cannot stomach the volatility of a management team that has demonstrated a severe tendency to over-extrapolate good times, bloat their fixed operational costs, and stretch their balance sheet.
Those are the undeniable risks. But after all of that rigorous stress testing, does Sartorius ultimately merit a perpetual long position in a concentrated portfolio?
What's the verdict?
The answer is yes, but with your eyes wide open to the operational realities. The fundamental thesis holds strong. The validated process regulatory moat is virtually impenetrable. The switching costs are simply too punitive in terms of time, money, and regulatory risk for customers to leave.
They are locked in.
The lifetime value to customer acquisition cost dynamics of their direct sales model, locking customers in at the amber R&D phase for a decade of recurring revenue, remain elite. And that 75% recurring revenue stream from single-use consumables guarantees a massive, durable baseline of cash flow through almost any traditional macroeconomic environment.
They're essentially the toll bridge for the future of complex medicine. Every time a biologic drug is manufactured anywhere in the world, Sartorius collects a toll.
Precisely. Because of that toll bridge positioning, they will very likely generate shareholder returns significantly above their cost of capital over a 5 to 10-year horizon. The secular tailwinds of an aging global population and the sheer volume growth of the biologic and biosimilar pipelines are just that structurally powerful.
And their position is secure.
Sartorius's positioning within that supply chain is that deeply entrenched. However, the caveat is critical. Investors must explicitly discount management's optimistic commentary. You have to independently underwrite and model this business, assuming the 36% margins of 2022 were a pandemic hallucination, not a structural reality.
Underwrite it at 30%.
You build your investment case on a normalized, sustainable 30% margin. You accept that there will be occasional capital allocation hiccups and M&A earnout volatility, and you simply let the sheer, unstoppable volume growth of global biologics compound your capital over the decades.
It is a fundamentally fantastic business with an incredible government-enforced moat. But you have to actively manage your own financial expectations because, as the last 3 years have proven, this management team will not do it for you.
Well said.
Thank you for joining us on this deep dive into Sartorius. As always, we want to remind you that investing for the absolute long-term searching for perpetual ownership requires immense discipline.
It's not easy.
It requires looking past the deafening noise of quarterly earnings misses, looking past the temporary panic of inventory destocking cycles, and rigorously evaluating the permanent underlying structural architecture of a business.
And it requires constantly asking the hard, uncomfortable questions about what actually protects that architecture from erosion.
Exactly. Which brings us to our final thought for today. We spent a lot of time establishing that Sartorius's seemingly impenetrable moat relies incredibly heavily on the brutal financial cost and time required for regulatory revalidation.
Right, the heavy stick.
It's the heavy stick that forces drug manufacturers to simply accept those 3% to 7% annual price hikes forever. But let's look at the horizon. As the global biosimilar market explodes, a market that is defined almost entirely by drug companies competing intensely on cost to offer cheaper generics to healthcare systems, at what point does the mathematical equation finally flip?
That's the billion-dollar question.
When do those generic drug manufacturers operating on razor-thin margins finally sit down, look at their spreadsheets, and decide that paying millions of dollars and spending a year for a brand new FDA validation with a cheaper Asian supplier is actually, finally, cheaper than paying Sartorius's compounding premium forever? Think about that.